Welcome to CoreLogic's housing market update for July 2021, brought to you by onthehouse.com.au. The housing market ended the financial year on a high note, with Australian dwelling values rising 1.9% over the month, taking housing values 13.5% higher over the year, the highest annual growth rate since April 2004, when the early 2000s housing boom was winding down after a period of exceptional growth. Each of the capital cities saw an uplift in dwelling values in June, ranging from a 3% rise in Hobart to a more subdued 0.2% lift in Perth. Values also trended higher across the regional areas of each state, apart from regional Western Australia, where the market slipped by 0.1%. Darwin maintained the highest annual rate of growth across the capital cities, increasing 21% in value over the financial year, followed by Hobart at 19.6% and Canberra, where values were up 18.1%. Melbourne recorded the softest annual growth, reflecting a larger downturn in housing values through the third quarter of 2020 due to the extended lockdown period, along with a softer growth trajectory in 2021. Across regional Australia, regional New South Wales recorded the highest annual growth in dwelling values, up 21.1%, followed by regional Tasmania at 20.8%. Regional Western Australia recorded the softest conditions with a rise of 2.2% over the year. Despite another month of strong gains, there are some signs that the heat is coming out of the market. The 1.9% rise in Australian home values through June sits well above the decade average of 0.4%. However, this month's growth rate is down 30 basis points from the previous month and 90 basis points lower relative to the recent peak rate of monthly growth back in March earlier this year. The deceleration in housing value growth can be seen across most of the capital cities and regional markets. It can probably be attributed to worsening affordability as housing values rise at a substantially faster pace than household incomes. Saving for a deposit and funding transactional costs are becoming larger barriers to entry for many prospective buyers. Softer growth rates are also emerging at the higher end of the market. Across the top 25% of capital city dwelling values, growth in the June quarter was 8%, down from 9.2% in the 3 months to May. While this 8% uplift was still the highest seen amongst the value tiers, the growth rate also had the largest month-on-month deceleration. The easing in the pace of growth at the top end of the marketplace is another clear sign of a shift in momentum. The rest of the market tends to follow movements at the high end, and this is the first time in 9 months that the high-tier growth rate has not accelerated. Sales volumes have remained elevated through to the end of the financial year. CoreLogic estimates there were approximately 582,900 house and unit transactions nationally over the financial year. That's the highest number of sales annually since February 2004. Every capital city and rest of state regions saw double-digit growth in annual sales, with the exception of Hobart, where sales activity fell by 0.6% over the year, and regional Tasmania, where annual growth rate in sales was 8.6%. New listings have risen alongside prices and buying activity, but the total amount of stock on the market remains low. CoreLogic estimates there were approximately 130,000 fresh listings added to the market over the 3 months to June, almost 8% above the 5-year average. However, in the same period, there are around 170,000 sales. The dynamic of sales outstripping new listings has been a persistent trend through the year. The result is total advertised stock levels remaining approximately 25% below the 5-year average. With demand from buyers outweighing advertised supply, the market dynamic continues to favour vendors over buyers. Auction clearance rates remain well above average, although they have reduced from the highs of late March. Typical selling time for homes sold by private treaty remain close to record lows, averaging 29 days, up from a recent low of 25 days, and vendor discounting rates remain very tight at negative 2.7%. The Perth housing market has shown a distinct softening trend over recent months, with the monthly pace of home value appreciation easing from a recent peak of 1.8% in March earlier this year to just 0.2% in June. The slowdown is evident across both the house and the unit market, and it's relatively uniform across the upper and lower quartile of the market, implying a broad-based slowdown in the rate of appreciation. The easing in capital gains comes as housing market activity remains strong, with annual home sales up almost 60% compared with the previous financial year. A few factors that help to explain the slowdown are the sales to listing ratio and trends in housing credit. Over the June quarter, the sales to new listings ratio was recorded at 1.1, the lowest of any capital city, implying buyer demand and fresh stock levels were more evenly balanced than the other capitals. Home lending trends have also eased across WA, with the value of lending falling over 2 of the past 3 months. Overall, the housing market has shown a remarkable turnaround from a year ago when uncertainty was rife and housing values were under downwards pressure. The housing market has surged on the back of a stronger and earlier than expected economic recovery, along with record low mortgage rates and a range of stimulus measures that have now mostly expired. However, the housing market has clearly lost some growth momentum. Persistently high rates of home price appreciation are proving to be unsustainable from both an affordability perspective and amidst renewed headwinds associated with outbreaks and spot lockdowns. We know that COVID-19 restrictions will impact transactional activity, but housing values have been relatively immune to the impact from the virus. Based on observations through previous circuit breaker lockdowns, we can expect to see sharp falls in sales and listings, followed by a swift recovery in buyer and seller activity, but there's been little impact observed on prices. Outcomes for the housing market will depend on how long lockdown conditions last across parts of the country and whether some of the institutional responses offered through 2020 are reinstated if an extended lockdown occurs. Affordability constraints and the potential for tighter lending conditions, along with higher mortgage rates down the track, remain the primary headwinds for the property market's performance. Even without recent developments in COVID-19 across Australia, it's clear that the housing market is losing momentum as affordability constraints build. Through June, several of the major banks have forecast cash rate increases earlier than has been previously indicated by the Reserve Bank. A sooner than expected uplift in the cash rate would bring forward mortgage rate rises and reduce demand for credit, as would other policy considerations such as higher serviceability buffers. More expensive credit, or credit that's harder to obtain, could further shift market dynamics back to more normal levels. There's a lot going on at the moment in the property sector. If you would like to stay up to date, make sure you're visiting the news pages and the research pages at CoreLogic.com.au.